Assalamualaikum class. In today's lecture, we will discuss the transactions that are related to current and long-term liabilities and their impact on an association with income statement and balance sheet. Learning these fundamental concepts will enhance your ability to analyze financial statements and recognize the impact of various liabilities related transactions on the company's financial health. So, before discussing the problem, I would like to mention a few basic things. First of all, any increase in revenue is also an increase in net income, which in turn increases owner's equity. So, net income has direct association with owner's equity. Likewise, if there's any increase in expenses, so the increase in expenses results in a decrease in net income, hence have the same impact on owner's equity, that is, uh, decrease in net income also decreases owner's equity. The second thing is current liabilities means the liabilities that are due or that are payable within one accounting period, that is within 12 months, whereas long term liabilities are payable over a period of more than 1 year, often extended to 5 years or 10 years or even 20 years. So here it is the problem. I have taken this problem from Financial and Managerial Accounting book written by Williams Haka Bettner. Chapter is 10 and the problem number is 10.1a. In this problem, there are 15 transactions. All transactions are related with the recording of liabilities, and what is required basically the impact of these transactions on income statement and balance sheet is required. So the impact may be it may increase revenue, expense, or income, net income, or it may decrease all these balance sheet and income statement items. So what we are going to do, we read one by one each transaction and we mention the impact of these transactions on the income statement and balance sheet. So in the first transaction, the company made a year-end adjusting entry to accrue interest on note payable. So what do you mean by accruing interest? Basically, we have learned adjusting entries in chapter 4, that accruing interest means you record interest expense. In this entry, you record interest expense on the debit side. This means that interest expense increases, and interest payable is also increases. So what we are going to do, the impact of this transaction on income statement is, um, expenses will be increased. So I for increase, and when expenses are increased, this means that net income will also be increased. Net income will be decreased. So the same impact on owner's equity, that equity will also be decreased. Whereas there is no effect on revenues or no asset is involved, interest payable is your current liability. So current liability will also be increased. There is no long-term liability involved in this transaction. Whereas in the second transaction, a liability classified for several years as long term becomes due within the next 12 months. Means it is a classification of long term liability into current liability by converting current portion. or this is the current portion of long term liability. So um, long term liability will be decreased and current liability will be increased because we are converting long term liability into current liability. So long term liability will be decreased, whereas current liability will be increased. So no effect on the income statement, no asset is involved, and no effect on the owner's equity statement or on the owner's equity. So the third transaction recorded the regular bi-weekly payroll. Payroll is an expense for the company, including payroll taxes. Payroll taxes in the initial entry, while recording payroll, the company record payroll taxes on the credit side as payroll taxes payable, amounts withheld from the employees, and the issuance of paycheck. Issuance of paychecks means the bank account or the cash account will be decreased. So there is no revenue involved in this transaction, so no effect. However, expenses or payroll expenses, or you can say salaries expenses or wages expenses, will be increased. So there's increase, and as expenses are increases, uh, as expenses are increased, then this means that net income will also be increased. Net income will be decreased because it is vice versa of expenses, and as net income decrease in these transactions, the owner's equity will also be decreased. Then current liability current liabilities are involved, whereas issuance of paychecks means the cash is also decreased, so the assets are decreased now. Then current liabilities means payroll taxes payable. So current liabilities are increased and no long-term liabilities are involved. So no effect on long-term liabilities. In next transactions, the company earned an amount previously recorded as unearned revenue. So unearned revenue is a current liabilities for the company, and this unearned revenue become or converted into revenue earned whenever the company provides services. So now in this transaction, unearned revenue converted into revenue earned. So revenue will be increased. As revenue increase, this means that net income is also increased, and thus owner's equity is also increased. There is no expense is involved in this transaction, no asset is involved, and the current liability will be decreased because the unearned revenue converted into revenue earned. There is no involvement of long-term liabilities in this transaction. In the next transaction, the company made arrangements to extend a bank loan which is due in 30 days for another 18 months. So, this 30 days amount or bank loan due means this is a current liability, but the company made an arrangement to convert this current liability into long term liability. That means that now this 60 days loan is payable in 18 months. So this current liability is converted into long term, so current liability will be decreased, and long term liability will be increased in this case. There is no impact on income statement, no impact on asset and owner's equity. So the next transaction, called bonds payable due in 7 years. No, I have skipped one transaction, which is F transaction, made a monthly payment on fully amortized installment on note payable, and assume that this is recorded, this note is classified as current liability. So in this transaction, basically interest expense is increased because made a monthly payment on fully installment note payable. So interest will be increased, then because interest is increased, net income will also be decreased, and same impact will be on the owner's equity, it will decrease. Then as it is a payment, a monthly payment, this means that cash will be decreased, or in other word you can say asset will be decreased, and it is a payment on of current liability, so current liability will also be decreased. There's no impact on long term liabilities. Then next transaction, the company called bonds payable, which are due in 7 years at a price above the carrying value of the liability in accounting records. So the company is calling back the bonds payable at a price above the carrying value. This means that the company is having loss on the redemption of that bonds. So what is the recording in this case? Here we have. So in this case, in this transaction, the interest expense will be increased. As interest expense will be increased, this means that net income will be decreased, and the same impact is on the owner's equity, which will also be decreased. Whereas the company is paying or the company is calling back its bonds payable, so company will have to pay cash to the bondholders, so cash or asset will also be decreased. There's no involvement of current liabilities here, but the long term liabilities will also be decreased, and no impact or no effect on the revenues. So the next transaction is the company issued bond payable as at 97. At 97 means the company is issuing this bond on discount because $100 bond is issued at 97. The bonds pay interest on 1st May and 1st November. So at this stage, when the company issued bond, the company received cash. So asset will be increased, as well as the bond will also be increased, and ball as bond is a long term liability, so you can say long term liability is increased. There's no impact on income statement of this transaction. Right now, no current liability is involved, and there's no impact on owner's equity. The next transaction is the company recorded on November 1st interest expense and made a interest payment on bonds referred to in part H. As we know that in this part H, in the previous transaction, the bond were issued on discount. So now, while interest expense is recording, Discount on bonds are also amortizing and recorded to credit side, thus increasing the long-term liabilities. So in this case, you can see that um, in this transaction, first of all, interests are increasing because you can see that interest expense are the company recorded interest expense. So it is increased as in expenses are increased. This means that net income will be decreased. So the same impact on owner's equity, which will also be decreased. So the company made semi-annual payment. This means that cash will also be decreased. And as I have discussed, that discount on bonds are amortizing. So that's why long-term liabilities will also be increased in this case. There's no impact on current liabilities. There's no impact on revenues from this transaction. The next transaction is also associated with H and I, recorded necessary adjusting entries for the bonds referred in part H. So, necessary adjusting entries, what necessary adjusting entries is required? This is related to accruing interest payable. So, in this case, interest will be increased or interest expense will be increased, and then there's a decrease in net income because of the increase in expenses. So the owner's equity will also be decreased. There's no impact on revenues. However, this is adjusting entry. So no cash is paid or received. So no impact on assets or cash. Whereas interest expense is a current liability. So current liability will be increased, as well as the amortization of discount on bonds payable will also increases the net income and will be recorded on the credit side. Net expense, sorry, the income, the amortization of discount on bonds payable will be adjusted in expenses, or you can say this amortization on discount will increase the amount that is recognized in expense. So that's why this discount or amortization of discount will be recorded on credit side and will increase um, long-term liabilities. So this is the impact on it. Next transaction is related with issued a bond at 102 now. In H transaction, we issued a bond on discount, while in this transaction, we issued a bond on premium. So at this stage, this is just a issuance of bonds. So at this stage, we just whenever company issue bond, the company get cash. So asset will be increased, and bonds payable is a long-term liability. So long-term liabilities will also be increased. At this stage, there is no impact on income statement, as well as no current liabilities involved, and owner's equity has also no impact on with this transaction. Next transaction is about recording of adjusting entries for the bond referred in part K. So while recording adjusting entry in part K, adjusting entry means the interest expense will be increased. So interest expense will be increased. And as expenses are increasing in this case, This means that net income will also be decreased. And then same impact on owner's equity. Interest payable is a current liability. So current liability will be increased, and amortization of premium on bonds payable basically decreases the expenses recognized. So long term liabilities will also be decreased in this case. Here you can see in transaction I, which was related to discount, long term liabilities were increased, whereas in case of bonds issued on premium, long term liabilities are decreased. So there's no impact on net income, no impact on revenue, and no impact on assets from this transaction. The next transaction is transaction recorded and estimated liability for warranty claims. So warranty claims are basically or initially recorded as expenses. So expenses will be increased, and net income is ultimately decreased. Then again, the same impact on owner's equity will also be decreased. Uh, Warranty claims are estimated warranty liability. So this liability are current liability payable within one accounting period. So this liability will be increased. There is no impact on revenues or assets or long-term liabilities. In the second last transaction, the company entered into a 2-year commitment to buy all the hard drives at a given price. So, this is just a commitment. No, there's no, you can say it is just in commitment. There's no entries made, there's no amount is confirmed, so there's no need to record it because it is a commitment. It has no impact on income statement or on balance sheet, so no effect overall. In the last transaction, received a notice that a lawsuit has been filed against the company for $7 million, and the amount of the company's liability, if any, cannot be reasonably estimated. As you know that the amount cannot be reasonably estimated at this point of time, so there will not be any impact of this liability on either the income statement or balance sheet. So there is no need to record. However, this transaction can be mentioned in you can say notes to the accounts. So no impact here in the income statement as well as in the balance sheet. So that's it from this lecture and this problem. Take care, class.